Hello everyone. In the yesterday's session, in the previous session, we have completed understanding the concept of what do you mean by normal distribution curve and normal distribution table, and we also understood the logic behind why they will calculate the normal distribution percentages. So the Z value, how to calculate four different kinds of tables that they give. One is called as left tail table or right tail table. That is one way. Second one is a mean to target number. Next one is a cumulative table. Next one is a two tail table. So mean to target table. Second one single tail table or one tail table. Next one two tail tables, and last one is a cumulative table. So this is what we understood very clearly in the last session. Now today in this session we are going to understand what do you mean by a value at risk and how many different kinds of calculations are there. Okay, let us try to understand clearly in detail regarding the concept of what is this value at risk, and I will be doing 7 different questions also in this particular lecture. Those 7 questions, if you understand, you can be able to do any kind of question that comes in exam. Along with these 7 other questions also I will do for you. Okay, but these 7 questions without missing them, do it. Along with the video, I will make this video as short as possible. I will be on dot, means what is required from the exams point of view, those things only I will discuss. 1 point extra, 1 point less I will not. In exam, if a question comes, you should get that 4 marks. For that, what to do? That's what I am going to do in this particular session. Shall we begin? So let's start. So see here. First one. Okay, first let me explain. Value at risk, also in short called as VAR calculation. What is this VAR? VAR always gives you, okay, VAR always gives you the worst expected loss for a person. What we mean is an investor for a particular period of time at a particular confidence level. I repeat, what is VAR? VAR is a loss number. VAR is what number here? Loss number. I repeat one more time. VAR is a loss number. It's not a profit number. It's not a return number. VAR is a loss number. Okay. What is this loss number? It is the worst expected loss. It is the worst expected loss an investor can get on his investment. For example, I am a day trader. Means what? I will enter into the market today, into the Nifty. I will buy Nifty today, okay, and I will sell tomorrow. I am asking my friend, if I invest today and come out after one day, what is the maximum worst expected loss that I can incur on the basis of the past experience of the Nifty? Okay, for example, I am buying TCS share here. Today TCS is trading at 4,300. Say example, I purchased. You are also a trader. You are my very good friend. I ask you, friend, I will invest. I will invest in what? I will invest in TCS shares. I will stay for 3 days. Say for example, how many days here? 3 days. Today I will invest. I will wait for tomorrow, day after tomorrow, and the day after. And then I will sell. Now I will invest 10 lakh. Okay, I will invest 10 lakh. My 10 lakh, if it goes to 11 lakh or 12 lakh, I am extremely happy that I am getting 2 lakh gain in 2-3 days. But I wanted to know on the basis of the past experience, I wanted to know the probability of, listen to my words, I wanted to know the probability of the worst expected loss, that amount of worst expected loss we calculate in 2 ways. One, as a percentage or as a amount. Means I can tell the worst expected loss will be 1.5%. Means what? You are investing 10 lakhs. 10 lakh into 1.5% means 15,000. You can express that in two ways. You can tell that VAR is 1.5%, or you can also tell VAR is 15,000. If you express in 1.5%, it's called as a VAR as a percentage. If you express that in 15,000, VAR as a rupee. Both are right. Exam mostly amounts only they are asking. Okay, mostly. One or two problems, percentages are also there, but mostly they will test you on rupees only. Okay, I repeat. What is a VAR? VAR is a worst expected loss. VAR is a worst expected loss. Okay, worst expected loss. Who is getting a worst expected loss? A trader can get for a particular duration of time. If you ask for 1 day, it will become daily VAR. If you ask for 3 day, it will become 3 day VAR. If you ask for 10 day, it will become 10 day VAR. If you ask for 6 months, 6 months VAR. 1 year ki 1 year VAR. All the questions are tested in exam. That means in exam already they tested 1 day VAR, 3 days, 7 days, 2 weeks, 3 weeks, 1 month, 6 months, quarterly and annually. All questions came in exam. We will do now also in the class today. Okay. So it is the worst expected loss that a person can get over a particular period. Okay, for the chosen period, either week, half month, etc. At a particular confidence level. Confidence level means probability level. Okay. Okay. It is theoretical. Rather than understanding like this, let us have one particular statement and try to interpret them. Okay. Before that, please read. Please read the meaning and components once. Okay. So VAR is a measure of worst expected loss. VAR is a measure of worst expected loss that a firm may suffer or a person may suffer over a period of time that has been specified by the user under the normal market conditions at a specified level of confidence. Components of VAR. VAR is a loss number. Okay, VAR is not a profit number. VAR is a loss. It's not a return number. It's a loss number. Okay, so it will be for particular period. Any period you give. It can be daily VAR. It can be 15-day VAR. It can be monthly VAR. Okay, confidence level specified by the user. Okay, sir, I didn't understand what is this confidence level. I'll explain. Let us see. Example 1. A person said like this. You are listening to the CNBC profit or NDTV profit or Market Watch. They said like this. One analyst said to you. Okay, what the analyst said? Daily VAR is 1 lakh at 95% level of confidence. What do you mean by LOC? LOC means a level of confidence. Level of confidence means probability. Okay? See here. Daily VAR is 1 lakh at 95% level of confidence. Do you know what do you mean by that? It is, or the person is 95% confident that, I repeat again, a person is saying that, for example, I asked you, friend, I am going to invest 1 crore rupees in the stock market today, and I want to take exit after 1 day daily. Okay, I am a intraday or 1 day trader. I will buy today and I will sell after 1 day. What is the worst expected loss that I can get? Then the friend has replied, friend, the daily VAR is 1 lakh. The daily VAR is 1 lakh. At 95% confidence level, your friend answered. What do you mean by that? Your friend is saying you that there is 95% confidence, means 95% probability that your loss per day do not exceed 1 lakh, do not exceed 1 lakh, or to keep it other way, there is a 5% probability that your daily loss can exceed 1 lakh, your daily loss can exceed 1 lakh. Understood the point or not? So this means during a day there is only a 5% chance that the next trading day will be, the loss of the next trading day will be greater than 1 lakh. Means what? It is 95% probable that the loss won't go beyond 1 lakh. 95% level of confidence can also be read as 5% risk level. Interpret this percentage statement. Instead of telling as 1 lakh, I can also tell as like this. Daily VAR is 1.36% at a 95% confidence level. What does it mean? There is, or it is 95% confident that, or there is a 95% probability that your loss per day don't exceed 1.36%, 1.36%, or there is 5% probability that the loss of a day can also go beyond 1.36%. This is the meaning here. Okay, 1 minute time I will give. Read the statement properly and try to interpret them properly. Once you complete, we go with the problems. Okay, completed. Now we are entering into the problems here. Okay, fastly I will complete out the problems from the exam's point of view. If a question comes, how you should react is a point now. Okay, this question only CFA question I am not going to take now. This is not relevant for exams directly. Okay, normally you can also solve that, but from the exams point of view, what is required, let us first complete them. Okay, from here it starts. So these facts. So solution I will do first, later you can check the answers. Let us see. Portfolio value 100 crores, daily standard deviation 2%, calculate the value at risk at 95% confidence level if the Z value is 1.645. Z value they have only given. Okay, formula. VAR has a formula. Okay, VAR has a formula. The formula for calculating the VAR is mean minus Z into standard deviation. Mean is given or not given? Not given. If mean is not given, Mean is always said to be in the middle. Okay, say for example, yesterday I told you mean when we calculated that. Okay, middle zero will be there, left side 50%, right side 50%. Mean is said to be 0%. So when nothing is given as a mean, we will take 0 minus z value 1.645 into 0.02. It is minus 0.0329. Okay, already you are telling that it is a value at risk. Risk itself means a loss. Loss always is a negative. So separately you need not tell that. You can write it as 3.29%. What do you mean 3.29? What do you mean 3.29%? There is 95% chance that the loss of one day trading will not go beyond 3.29%. 3.29%. No, sir, I want in amounts. VAR in rupees equal to 100 crore into 3.29%. Okay, so now we need to multiply both of them. 100 into okay, 3.29 crores. What is this 3.29 crores? This is the value at risk in rupee terms. This is a value at risk in rupee terms. See here, same. So VAR equal to mean minus Z into standard deviation. Mean minus Z into standard deviation. So let us understand what does it mean. The portfolio value given in the question is 100 crore. Okay. Therefore, portfolio value can maximum reduce and become how much? 0. When mean is not given in the question, we assume mean as 0. The assumption of all the points. That's why mean is a 0. Next. So, VAR equal to mean minus Z into standard deviation. Mean is always assumed as 0 minus Z value 1.645 into 0.02. It came to 3.29%. This is in percentage term. Okay. You can calculate that in the rupee terms as follows. The amount of portfolio value into 3.29%. Okay. You can do this way. No, sir, I don't want to do this. Is there any alternative? Yes. ICAI will use this formula minus wealth into Z into standard deviation. Why minus? Value at risk is a negative number, risk value. Okay. You forget about symbol now. Wealth. How much I invested? 100 crore. Z value is how much? 1.645. Standard deviation 2%. Take calculator. 100 crore into 1.645 into 2%. Again, this is also coming to 3.29 crores. So tell me, value at risk ki two formulas are there. Mean formula, wealth formula. Okay, mean formula. Mean minus Z into standard deviation. Wealth formula. W into Z into standard deviation. Okay, so these are the formulas for calculating value at risk. Which problem was completed? One of the question is over. Okay, next let us take another question and try to do. Okay, let us start. Let us see this question. Okay, next question. Facts. Portfolio value 100 crore, daily standard deviation 2%. Calculate the VAR at 99% confidence level. Z value given 2.326. Okay, next. For how many days? 10 days. First, calculate VAR for how many days? 10 days. Directly we cannot calculate for 10 days. Let us first calculate for daily VAR, and then daily VAR, if you get one value into some number of days, will give you 10 days VAR. Okay, first daily VAR. Okay, daily VAR. Direct portfolio value ne given. So let's not go by mean formula, directly portfolio value. So the VAR is equal to wealth into Z into sigma. Wealth 100 crore into Z value into standard deviation 2%. Okay, 100 crore into 2.326 into 2%, 4.652 crore. What is this 4.652 crore? There is 99% probability that the loss will not go beyond 4.652 in one day. In one day. Okay. 10-day VAR. Okay, 10 days VAR. Whenever 10 days VAR is calculated, daily VAR into T. Daily VAR into T. Okay, number of days. T means number of times. Okay, next. Daily VAR is how much? 4.652 crore into how many days you want? 10 days equal to rupees 4.652 into 10, 46.52 crore. Wrong. Like this, you should not think. Sir, daily VAR you got 4.652 means obviously 10 days means into 10. Wrong. Listen carefully. We are considering not one share, we are considering a portfolio, or even for that case. When I say daily VAR 4.652, some days I may get profit, some day I may get loss also. Sir, I will give you an example here. When you take Nifty, today it will rise, tomorrow it will fall. Day after tomorrow and that day after it rise, again one day it fall. That means every day you will not get a loss. We are telling that there is a chance that next day it can fall up to 4.652 crores maximum. Okay, that means I am 99% probable that your loss will not go beyond 4.652 here. 99% probable. Okay, there is only 1% chance that your loss can even exceed 4.652. I am 99% confident that your loss will not go beyond 4.652 crores for one day, that is the next day. Next day, maybe loss can be there, gain can be there. One day, this is the answer. Therefore, to next day, if it is 4.652, that does not mean every day I will get 4.652, 4.652, 4.652. One day rise, one day fall, 2 day rise, 3 days fall, anything can happen. Therefore, when rise is there, compensatory fall will be there. When fall is there, compensatory rise will be there. Market la nothing is permanent. Humps and bumps are very very common. When rise you are seeing, fall also you will see. When fall you are seeing, rise also you will see. That means whenever there is a fall, compensating rise will be there. Whenever there is a rise, compensating fall will be there. That's called as market diversification effect. Market diversification effect. Portfolio management you will see that whenever two securities you are investing, automatically diversification will come. Okay, formula how to show diversification? Square root you will take. Everyone take your calculator once. Type number 60. Okay, this is risk. Okay, put a square root to this. 7.74. Now risk is reduced, the increase from 60 it came to 7.74. Square root always neutralizes the risk by using diversification effect. That's why portfolio chapter all the formulas will use a square root. Okay, here also same. Daily VAR into, instead of T, use root T. What is a daily VAR? 4.652 into root of 10. 10 root into 4.652. Answer is 14.7109 crores. 14.7109 crores. That's it. I have rounded off to 2 digits. Are you understanding the point or not? Whenever they give a question on 10-day war, 15 days war, etc., don't directly take it. Multiply with square root of t, not with t. Understood the point or not, everyone? Okay, done. Next, question number 5. Let us take this. Okay. Daily war is 12,500. Calculate weekly war, monthly war, semi-annual war, annual war. First listen. Where chapter ki week will have 5 days, month will have 20 days. Okay. Month will have 20 days. Half yearly will have 125 days. Annual will have 250 days. This is the assumption. Okay. Daily war they have given. Weekly, monthly, semi-annually, annually. Let us calculate. Weekly war. Okay. Daily war into root of 5. 5 के root into 12,500. 27,951. Monthly. Daily war into root of 20. Calculate. 20 square root into 12,500. Next, daily war into root of 125. 125 square root into 1,39,754. Annual. $1,97,642. So 4 numbers we got. How much? 27,951, 55,902, 137,754, and 197,642. Okay. Same. Just small 2 rupee, 3 rupee different. 55,900 I got. 55,902 I got. Small differences, decimal differences will definitely happen. But overall, everyone understood the concept clearly or not? This is how we need to calculate the question and answer. Next. 6th question. Portfolio value 100 lakhs. Okay. Annual return 20%. Annual return 20% means mean return 20%. Standard deviation 30%. Okay. This is per annum. Calculate the daily war at 95% confidence level. First, annual given, first calculate the daily. Because you are asking daily war. Daily mean equal to 20% divided by per annum. This is, I want per day. 250 days we assume. .08%. Daily standard deviation. Annual standard deviation divided by root of t. Whenever risk is calculated, diversification impact ki root will be taken. 30 divided by 250 ki root. 30 divided by 15.8114. Okay, this is a situation. So what is asking? Calculate the daily VAR. Tell me, what is the formula for the daily VAR? Portfolio wealth into, sorry, mean value given na. Okay, okay, mean value, nothing is said na, 0. Z value 1.645 into multiply 1.645 into 1.8974% minus 0.0312% in value. Okay, so finally if you wanted to see the answer, it looks this way. See, that's the answer. So mean you can take value as 0, or mean you can take as a percentage like this. Okay, you can take in either ways. This here I have taken as a amount, and you can take also as a percentage. So first one, mean per day we calculated. After that, this we calculated. Okay, mean as an amount if you take, it will be 0. Mean as an amount if you take, it will be 0. Next, mean as a percentage if you take, mean as a percentage. VAR equal to mean as a percentage minus Z into standard deviation. Mean as a percentage, tell me how much? 0.08% minus Z value 1.645 we already know, into percentage, how much we got? 1.8974. I have taken 1.9 in my notes, no problem. So 1.645 into 1.8974%. Okay, we got the same 0.0312 like that, minus 0.08. Okay, so see, what we need to do is, you can calculate the VAR using a mean as a percentage. Mean minus Z into standard deviation. Mean 0.08%. So figure I'm not taking any value, minus Z value into 1.8974. Okay, so write this, you have taken in percentage na? This also you express in percentage directly. So directly you can multiply 1.8974 into 1.645. So 0.08% minus 3.12%. It comes to 3.04%. They got the answer as 3.05%. 0.01% difference is okay. Okay, this is the next problem. You can do in either ways. Very important. Next question we are going to take. I will do one thing. This I will directly show you and solve, such that within short time we can complete. Point number 1. So let us see the facts of the case. The portfolio value is rupees 10 lakh invested in security A. Another 10 lakh invested in security B. Daily standard deviation of both A and B are 0.1% each. And a sigma A is 0.1, sigma B is also 0.1. Next, correlation 0.3, and calculate the 5-day VAR at 95% confidence level. 95% confidence level, already we know the Z value. How much it is here? 1.645. Okay, first, wealth of A, you are having 20 lakh. You kept 10 lakh in A, 10 lakh in B. Means WA 0.5, WB 0.5. Sir, we are taking, they have given daily standard deviation of both A and B as how much? 0.1 each. Okay, this is also given. So we should know, we wanted to know the total portfolio value. They have given individual security standard deviation. We wanted to do for the entire portfolio. Entire portfolio value is how much? 20 lakh. Okay. But what is the portfolio standard deviation? Using the portfolio chapter, we have to do that first. Okay. So, portfolio chapter, what is the formula here? Root of wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma y r x and y. Same formula. First use and wa square sigma a square wb square sigma b square plus 2 wa wb sigma a sigma b rab. Multiply. You will get one answer which came to 0.00806%. What is this? This is the portfolio standard deviation. In the previous questions, they have given this number. Okay, in the previous questions, they have only given this number. Now we are calculating it using our portfolio knowledge. So step number 1, step number 2 completed. First step number 1, gather the information. Totally 20 lakh is there. In that 0.5% of your total wealth is invested in A, 0.5 will be invested in B, 50% in A, 50% in B. Total portfolio value is 20 lakh. Next, daily standard deviation of each of the securities is also given. How much? 0.1%. Correlation is also given, 0.3. 5-day VAR he is asking us to calculate at a 95% confidence level. 95% confidence level, Z value already in the previous questions we have taken 1.645. First we calculated this. After this, what we need to calculate here? We know the portfolio value. Just we need to calculate the VAR. VAR equal to, for a portfolio, how to take? Wealth into Z into sigma. What is the wealth? Two 651. Perfect, correct. So 2651.74. Okay, this is the 1-day VAR. Okay, this is the 1-day VAR. Now we want 5-day VAR. We want how many VARs, sir? 5-day VAR. Into root of 5. 5929. 5929. That's it. With this, all kinds of main questions in the VAR concept has been completed. So, VAR calculation, whenever you do, the only important thing you need to understand is how to interpret the information and how to extract the data given and try to solve the problem. That's it. Okay, these are all the basic problems. Basic problem is not basic simple problems. These are all exam questions or study material questions which I have done. Okay, this is a short video where I just wanted to tell all the students, do these problems without fail. Okay, if the question comes, generally it comes from these 7 questions, one question can come. Okay, and another video I will make extra questions also on VAR calculation. Those who are interested can also visit to that. Clarity everyone.